Hey, good afternoon, everyone. My name is Vladimir Bosanac. I'm the co-founder, publisher of the Registry. I'm one of your co-hosts here for today at the Real Perspectives podcast, and I'm joined here by David Arscott. David.
Hey, Vlad. Good to be here.
Excellent. David, tell us a bit about you and what your company does.
So Baycrest Capital is my company. I've got several different clients involved in two kind of differing arenas, one being debt acquisitions. In that front, I work on debt acquisitions coast to coast, mostly on the real estate valuation side, so understanding collateral value on those loans that they're acquiring. And then I also work in underwriting and acquiring multifamily and industrial properties, largely focused in the Central Valley and West Coast markets, but really most of the West Coast on that front. But between those two kind of arenas, have a pretty good pulse on the real estate markets around the country, and with probably a bigger emphasis on industrial and apartment properties.
Yeah, David is one of our star co-hosts here, who's going to bring an industry perspective to this conversation, which I appreciate quite a bit. So, looking forward to having a fun discussion here about some of the things that are going on in the commercial real estate space. So, hey, listen, without further ado, let's kick into some of those topics. David, I think you had one that you wanted to kind of, kickstart us off with.
So one of the things I was interested in speaking about was CMBS distress, and some recent headlines have called out CMBS distress at over 12%, which is an all-time high. And I think that that's an interesting data point in our market and the lending world, because while CMBS debt is a small part of it, there's obviously bank lending, private lending, and
Sure.
Other types of lenders. But the fact that CMBS distress is so high right now shows a lot of the pressures that we're seeing on lending around the country. And so what I think is really happening and is pushing those distress rates so high is a shift in lending in the last few years that has really crunched investors and buyers in terms of what kind of loans they're able to get. And so loans that were underwritten and closed in 2018, 2019, even 2017 have higher LTVs, lower cap rates. And so now that those loans are coming to maturity, people aren't able to refinance them and get out of those loans. So I think that distress on the CMBS side will be one factor, but perhaps an even bigger factor is the indication that this, goes into other types of lending as well. And you're seeing that across the board. Banks will lend and extend and pretend, if you will, for as long as they can to, so that they don't have to write these things off. But we're already starting to see it, certainly in some high profile office deals. But it's going to start to creep up in other property types as well.
Yeah, it's super interesting. And David, do you have any sense, when you read these headlines that we're at a record defaults? Is it higher than where it was during the Great Financial Crisis, or are we approaching numbers like how real is that estimate when they say it's record high?
That's a good question, and it all comes down to how you measure it, right? And so the exact
as usual, right?
right. So the exact specifics are probably hard to nail down. It seems difficult for me to believe that we're in a worse place now than we were in 2008. But I think that it's probably just a sign of the way that people are looking at it now. And I think things are under maybe a little bit of a better microscope now than they were back then. So some of those triggers might not have gone off in the previous cycle. So the distress rate then may have been 20%, 30%. And the way that we were measuring it just wasn't quite as accurate as it is now. That
Yeah.
would be my
Yeah.
guess, and I'm not entirely positive about that. But
Yeah, that's it's just one of those things. I am curious. Did we experience more people going to CMBS debt because over the last I don't know few years the interest rates have gone up, so it's become kind of a not the lender of last resort, but certainly kind of a kicking the can down the road kind of strategy. And now we're coming to the end of that. I mean, is that partially why it's playing out at this point in time?
that's a good question. There was definitely such a big downfall or a decrease in CMBS lending in the wake of the financial crisis, and so that's really something that uh, for years there just really wasn't much CMBS lending, excuse me, going on at all.
Right.
And so I think that, over time it started to creep up. CMBS lending is attractive for a lot of reasons, but it also has its pitfalls. And so I think that I'd have to look at the exact numbers, but I know that for a long time it was really pretty insignificant in terms of
Yes.
the overall pie. So I'm not positive if the current lending environment has really contributed to that, or if they were just two things that were kind of going on simultaneously.
Yeah, I mean, we'll definitely keep our eyes on it. I mean, I think it's kind of interesting evolution, and it definitely plays a big role in the commercial real estate space. I mean, interest rates don't seem to be going anywhere, but sort of flat, if not maybe up, now that inflation is back up again. I think a lot of people sort of forget that those two things are, tied, right?
Definitely.
If inflation goes up, interest rates will go up as well, right? And vice versa. So I don't think there's any hope of seeing interest rates going down, at least in the foreseeable future. I mean, that's kind of my sense. So. Another kind of thing that's related to this, but interestingly, is that on the private side of the market, we've seen some very big players, not that many players, a handful of players have raised some tremendous amounts of money and putting into private debt. Something along the lines of like 1.8 trillion. And that number is up from something like 400 billion. So I mean, really a huge jump over just the last, I don't know, 5-6 years. David, have you seen this? Is this something that you're also tracking? Do you think this is going to play a role in commercial real estate at some point as well?
Yeah, certainly seen the headlines, and I think that a lot of the private lenders will move into the real estate market, and I'm sure that they're all looking for deals today that'll make sense for them. But when you have the greater macroeconomic market pressures that we've been seeing in the last few years, especially rising interest rates, which have bumped up cap rates. The banks aren't able to lend as aggressively, and so that gives private lenders bigger opportunities to come in and have an impact on the markets. Obviously, that squeezes investors and real estate owners as they have higher interest rates, because the private lenders require a higher interest rate generally than banks and CMBS. So I think it will play a role. Obviously, it's a lot of money, a lot of big numbers that are being thrown around. And so that should play a role. And I think it might help us ease some of the issues that we're seeing, but it also is kind of a short-term issue as well, or a short-term fix, I should say, because those
In what
loans will
way? Yeah.
still come due.
Sorry, David. How is it a short term issue?
Oh, a short-term fix because the private lenders with their higher interest rates will still have, if they take out a bank in a capital stack, those loans are often shorter term than the bank loans, and
Right.
so eventually, it's still the owner waiting for better bank terms to come around in the end to refinance out and get back to a more sort of traditional capital stack. So, yeah, it'll be interesting to watch, and I think that there will be a need for more private lending as we go forward and we hit more of these maturities. But the question is, how much of it will just be sort of extend and pretend on the bank side,
Yeah.
and how much will actually get worked out with private lending and other sources?
For private lending, is this for some? I don't know if this is the case for all, but for some, is this also part of their kind of asset acquisition strategy? So they effectively hope to take possession of these assets through either foreclosure, or they're buying the debt at a huge discount. What are your thoughts about that?
Yeah, it's a good question, and I think that different groups obviously all operate differently. The debt acquisitions that we do are more traditional, holding the note, working with borrowers and trying to work it out that way. Foreclosure is in the wake of the great financial crisis, you did have a lot of developers and investors trying to buy notes at big discounts and get into properties that way. It's really less. I've seen less and less of it over the last 10 years, I'll say. And it certainly can be a strategy, but dealing with notes and all the legal issues and everything else that come with them are not really in the wheelhouse of developers and local or regional investors who want to get into properties. There's a sort of a disconnect there, I would say. Certainly, certain lenders aren't afraid to take properties back and
Yep.
work with them,
Yep.
especially on the private side where you have a little bit more, or excuse me, a lot more flexibility than you do on the banking side. But yeah, I haven't seen any signs of that yet in the work that I've done. But I'd be interested to see if that's something that starts to come up.
Yeah, it is an interesting kind of concept because we've seen just through some of our reporting on the West Coast. I can't point and say hundreds of properties have traded like this, but certainly there's been a few like that. Most notably, there is an owner of an auto group in Portland, that just purchased one of the biggest buildings in downtown Portland. They had a huge discount, right? I would not be surprised if he, secured debt through some kind of a, private fund, right? I have to go back and sort of double check, make sure that that's accurate. But the point is, some of the transactions that we're seeing are still, we're still seeing a number of transactions where deals are trading at a huge discount, like 80%, 70% of where it was. So that does seem to still be happening, but I am curious, how that will play itself out, because I don't get a sense that we're still done with that, right? I mean, you probably see this more than most people do, but I suspect there's still a good number of these properties that will go to this kind of, proverbial pig to the proverbial python, right? Is that a fair assessment?
I think it is. I definitely think it is. In even 2 or 3 years ago, we were starting to see one or two of these transactions popping up, and it really is a lot more frequent now. We look at stuff all over the country, and even in different markets. I've talked with brokers in Philadelphia and other markets recently who have said, there are major financial hurdles that owners are going to have to overcome in the near term in a lot of these markets. Mostly talking about office, but I do think it's going to bubble into other property types as well, because of the macroeconomic issues that we're dealing with. And so as those issues pop up, I have seen them, I would say, more and more recently. And, it used to sort of be one transaction here, one transaction there. And there's more of a churn now, I would say, based on what I've seen around the country. There are more of those deals starting to kind of bubble up.
Yeah, and I don't think anyone is advertising those deals.
No.
I think the buyer doesn't want to embarrass the seller. The seller definitely doesn't want to talk about it, right? So, it is interesting. Yeah, we'll be going through some of that for some time. Yeah, it is interesting. I mean, my sense is that given the amount of money that's gone into private debt, and I'm sure this will go into equities and other things as well. I don't think this is just being allocated towards commercial real estate, but I'm sure it's going to have an impact on commercial real estate. I mean, just like any other asset class. I think these, folks like, Blackstone and others that are kind of doing this KKR, right? They're going to look at everything. They're going to look at portfolios, whether it's, real estate portfolio, equity portfolio, whatever, private equity stuff, right? So I imagine it will play a role in real estate, and perhaps even ease, the situation that we have with maybe some of the lenders, right? Well, they will come in and make some of these deals happen so that the new owner can reset, and then hopefully lease it at a whole different level, right? Which is kind of what everyone's hoping that happens, right? So
Yeah, absolutely.
yeah, we'll keep our eye on that. So you had one kind of point of interest around conversions, right? Commercial to residential conversions. David, tell us about what's piquing your interest in this space. You're certainly not the first that's been talking about this, and there are some activities around this, but it's not receiving kind of like a huge boost, right? So curious where you are with this.
Yeah, I mean, office to residential conversion has been a big topic, and I feel like maybe the buzz around it has softened a little bit. Like, you see stories here and there, but for a while it was all anybody would talk about, especially in places like New York City. I mean, New York City is probably the epicenter of that, but it's something that I've come across, over the years in sort of random markets in the last, call it 3 to 4 years. Richmond, Virginia, randomly. Stamford, Connecticut, also pretty randomly. But both markets where way oversupplied in office, as many, if not all, markets are potentially across the country. But the prices get low enough that you can make a conversion deal pencil.
Yeah.
And I think I mentioned to you earlier this week, Vlad, that I'm just so curious to hear from an architect, right, about the nuts and bolts of how to make that happen, right? And it's sort of like, it's like any development deal, right? Your basis is a piece of the pie, but the
Right.
costs can be so astronomical for construction that it can be tricky to make it pencil, even if you're getting really low. I mean, in some of those deals that I was kind of mentioning, you're looking at purchase prices of $10 to $20 a foot for the
Yes.
old office buildings.
Yep.
Numbers that in our markets here on the West Coast seem completely crazy.
Right.
But in a lot of those East Coast markets, you can buy an old junky office building for $15 a foot.
Yeah.
And the question is, how much does it cost to convert it to multifamily, which you can then sell for $150,000 a unit,
Yeah.
right? And so yeah, it's a fascinating area, and a lot of the low-hanging fruit, I think, has already been harvested on this one, right? So the smaller buildings that have favorable floor plates and all that, people have come in and said, hey, I can do this. I can find an old junky office building in Manhattan and turn it into cool lofts and sell them for $2 million a pop and make a bunch of money, which is great. But it'll be interesting to see where we're able to do that around the country as we have office vacancy rates of 20%, 30%, depending on what market you're in, and a lot of that empty space. It'll be definitely something that I've watched, and I'm just so fascinated by the idea. I'd love to walk a property.
Yeah, no, totally. We've covered this over the last few years, to some extent, and some of the things that we were seeing, kind of from an architect's point of view, the biggest point of contention is whether the physical space can take housing, right? And sometimes it's as simple as how many bathrooms you can squeeze on the floor. Are you able to subdivide the floor in such a way where you can have kitchens and bathrooms and that kind of thing?
Right.
And in many cases, like some of these buildings, they don't have that kind of infrastructure built in. So that's one of the biggest. That's probably one of the biggest issues. The other that we've seen, which is sort of interesting, is on the owner side. Most of these properties tend to be, if it's a commercial property, it's owned by somebody who specializes in ownership of commercial buildings, right? This person or this entity may not necessarily be an expert in multifamily or in condo development, right? And so they may not have an incentive to do something like that. Number one, right? Number two, depending on where they are with their debt, right? They may want to sort of wait it out, especially if the bank is willing to kind of work with them and just sort of see where the market is. There have been a couple of deals actually just recently in Sunnyvale. There was a deal that was kind of an office building that was about to be converted. I believe one of these affordable housing folks came in and put a bid on a project. And then a tech company came back and outbid them to keep it a commercial building, which is very interesting. And I don't think this is something that happens across the country, but certainly here in Silicon Valley, right? It might be more of an issue. The interesting thing about that whole deal is when I was talking to a city representative, the city representative was actually more excited that it remained a commercial office building than, right?
Definitely.
And I think part of it is, this is sort of, I think, a dirty little secret, is that I think the cities and the counties make more money off of a commercial building than off of residential. So in a way, for them to rezone something, that can be a challenge as well, right?
No
so my sense is a lot of moving parts here, and it kind of, the stars have to align for a building to be converted. And I think you're right. I think the universe of those stars is not very big.
Definitely.
So,
Definitely.
Yeah. But it is a shame. I mean, I think certainly, housing continues to be, an issue. Certainly here on the West Coast, we start to see numbers of like, median household housing, cost is like, over $2 million at this point in some parts of the, Bay Area, which is, really something else. So hopefully we can build more. But yeah.
Definitely.
So David, one of your specialties is industrial, right? Let's talk about industrial a little bit. That's certainly been a hot market over the last few years. Tell us, what are you seeing?
Yeah, I mean, the headline that spurred the whole thing was industrial vacancy peaks as demand holds and supply slows, which, was a Cushman headline, and I think really captures everything.
And this is a national headline, on the whole is what they're saying, right?
National headline. I mean, even in the first blurb, they talk about Chicago and New York with some of the activity that's happening there, but yeah, national headline. And it's exactly what I've been seeing in the market. Really, vacancy has just been creeping up. And, in markets like, in San Francisco, we still have extremely low vacancy. The Bay Area, extremely low vacancy. You've mentioned robotics and other factors as markets that or industries that are sort of fulfilling that supply now, or creating that demand for space. So in the Bay Area, we still have really low vacancy, but Central Valley, LA, Inland Empire, all starting to creep up. Different property types, or different tenant types, are not having as much demand as they used to. I mean, just a couple years ago in Los Angeles, quoted vacancy was well under 1%. And now I think you were talking about some of the numbers before. We're up to like 6 or 7% in Los Angeles.
That's right. Los Angeles is hitting those figures, and as is the Inland Empire, which is kind of the biggest industrial market in the country. Mm-hmm. And that is what we're seeing, is that it's been relatively soft. Mm-hmm. Interestingly, also, you mentioned the robotics tenants here in the Bay Area. Also, as some people like to call it, physical AI. one of these attempts where they're trying to put AI, attached to any
Totally.
business, right?
Totally.
But it is interesting. I kind of feel like in the last cycle, and by last cycle I mean 2011 to COVID, 2020. That was sort of that cycle. It was really all about e-commerce, right? I mean, I think Amazon was kind of gobbling up space. I think there were other retailers who were just using their stores as like showroom space, right? They weren't really holding any sort of product there, and then they would ship out of these regional centers from Central Valley or kind of other parts of the country that are close to the big metropolitan areas. Certainly in the Bay Area, from everything that we've seen so far, robotics has really been super interesting. Any industrial property that has extra power is immediately gobbled up, even if they don't use it, even if they don't need the space. Even if there's a property across the street that has the power, they're never going to use the space. They just take it for the power, which is kind of what we're hearing. And when you think about robotics, I think we've seen some of these YouTube videos of Tesla with the Optimus robot trying to fold clothes or whatever. I think that is a very simple and maybe a trite sort of use of that product. I think we're going to see these kinds of robots in factories. I think we're going to see them in warehouses. I think there's going to be a lot of different use cases. And I think people are trying to sort of figure out, who can be there first. I mean, I've seen some, crazy YouTube videos from China, which are sort of scary in a sense, how good their robots are.
Yeah.
And I feel like there's a lot of companies here stateside that are probably trying to do that. Inland Empire, West Coast, the Empire seems to be soft. Portland market seems to be relatively soft. Same with the Seattle market that we're seeing. I believe, David, some of the demand that we've seen recently in Southern California has also been tied to defense and aerospace, which has been interesting. So, with the growth of sort of, X, and now Amazon has its own, satellite arm, Anduril, which is a big defense contractor now, those are the kind of folks that seem to be taking up more space. Have you seen the same?
A little bit with those types of tenants. The bigger thing for me is more of a wider brushstroke, I would say, where after COVID, COVID was this very acute jab to the system that sort of shook everything up and changed everything. And, you mentioned e-commerce and all the activity that was happening, up to 2020. And I would say even after 2020 was almost more important for those types of players, where
Right.
you had so many people spending more time at home, people going into the office less. And so that old office, the old office demand and other things that people used to do in person went to the home. And so you had all these industrial servicers who were servicing people at home. And so that really was helped to fuel things, along with general economic optimism, right? I mean,
Yeah.
the market, if you look at GDP just alone, or S&P 500, everything else, with the small blip of COVID, things rose straight. So for over a decade, right after the Great Recession, well over a decade.
And even after COVID hit, I mean, I think the economy
100%.
continued to, churn essentially, right?
I mean, after COVID, it was almost like a rubber band bounce back, right? I mean, it was so extreme. And just from a real estate perspective, we saw that with hotels, right? You had the hotels got hit so hard in COVID, and then the bounce back was extreme. And now you're starting to see that soften. I literally yesterday got an email from a company that tracks ADR and RevPAR information in Texas, and all the Texas markets have been softening. So the hospitality markets, Austin's still doing great, but RevPAR is down in Austin over the last year. Same is true in Houston and Dallas as well. So we're seeing, we had that big surge after COVID, and it just, all that momentum kind of rolled into the overall economy, which was strong. And then now we just have, I don't know, fatigue of growth, and the market, for all the for all the political shenanigans and everything else that have been happening, the market overall has been pretty strong. We've taken lumps here and there, but overall, it's not like the economy is in recession or something. And yet, the long-term outlook.
I think you may have just jinxed us by saying the R word.
I mean, it's recessions. There was a good quote that I heard in the last cycle. It said, recessions don't die of old age, right? So it's like or don't, or growth periods don't come from old age or something like that. I can't remember the exact quote, but yeah, it doesn't just happen. Something has to spur it, but momentum sort of plays into things as well. And I think right now the real estate market is reflective of the overall sentiments of the country, of, some concerns about things, some fundamental shifts. Lending is just very, very different right now from how it was 3 years ago, especially 5 years ago.
Yep.
And so we just have a different output. I mean, we can't underwrite the types of rent growth that we were underwriting 3 years ago for industrial apartments, certainly not office. Office 3 years ago, maybe you were already, you weren't underwriting any rent growth anyway. But all those things have softened, and so it means fewer deals getting done and just a murkier outlook. So we'll see how it all plays out.
We are seeing on the industrial side, things moving a little bit sideways towards the data center space. There's been a lot of pension funds and institutional folks that are putting money in kind of funds specifically designated towards, as they call it, infrastructure. But infrastructure today means energy, and then obviously, space for data centers. I think that might spur some industrial, development. We are seeing, even with the softening in Inland Empire, there's about 6 million square feet in production, right? With just 5 projects, which is interesting, right? And then there's a developer in Palmdale, also in Southern California, who just won entitlements for 9 million square feet of industrial. So clearly, people are seeing that there's going to be opportunities for growth. I am also curious if maybe there's some older product that will have to be retired, that maybe was built 20, 30 years ago. And this is maybe kind of a natural cycle of, putting some, newer product, newer stuff, right? That happens kind of on a natural, basis anyway, right?
Yeah. And with vacancy rates where they are now and creeping up, there's no pressure. There's more pressure, I would say, to, the flight to quality, right? So if there's that much vacancy, if you're a tenant going out there looking for 1,000 feet all the way up to 200,000 feet or 1 million square feet, you're going to have more options now. And so they'll pick the better properties, the newer properties, and, we'll have the natural cycle. But industrial was such the darling for so many years, and it's definitely softening. We're seeing that. There's no question about it. So
and let's not forget legislation, right? I mean, we just passed a law. Was it the beginning of this year that it was in effect, or maybe last year in California? Building industrial has become harder. So I'm curious if that has an impact. I'm sure it will in some markets. But that's.
Yeah, I mean, and another factor that brings up, Vlad, is construction cost, which is purely astronomical. In a lot of cases, you can't build property for the property will be worth less than the construction cost when you build it, right? So if you say, hey, I want a 1 million square foot industrial property, cap rates aren't where they used to be, right?
Yeah.
So you can't underwrite a 5% exit anymore where you could 3 years ago. And so those values are not lining up with the construction costs, which are only going up. and there's
Right.
only upward pressure on that. So yeah, it's a lot of different factors that are playing around at the same time, and so it will be interesting to see how that all progresses and where vacancy goes. I mean, I'm very curious about that. You know, Cushman's saying that it peaked. Does that mean that's that's the current? Is that the forever peak, or is that a temporary peak?
Right.
And
Right.
you know, maybe with some exceptions, it'll be interesting to see. I'm a little bit curious about another topic that you brought up with data centers, and you know, it feels a little bit to me like iOS a few years back, where there was so much buzz around industrial outdoor storage, and you didn't have enough of it, and people didn't, you know, and investors realized that, and the tenants, you know, were begging for it, and so you had this huge surge. You had properties. I know in LA, Denver was a big hotspot for this,
Yep.
where industrial land was selling for huge prices, and that has softened a lot recently. So I
Oh, interesting.
wonder.
Interesting. Because we've seen quite the opposite. So I'm wondering if you're seeing stuff ahead of us where the news hasn't hit yet. You know what I mean on the transaction side,
Yeah, and
because we
I
have
think a
seen
lot of
quite a
it.
few deals happen.
Yeah, I think a lot of it is supply constraint. We were recently looking at something down in Los Angeles area, and you know, comps from two or 3 years ago were like double what they are today,
Wow. Okay.
for
Interesting.
industrial outdoor storage land. And so those investors were all fighting against each other, driving up the prices, and that market has softened a little bit. So, you know, with data centers, it's a little bit different because you know, the big players, your Facebooks, Googles, you know, the massive titans of industry are the ones who are doing that. Amazon, others, and so they're going to do it. And it's if you know, if they spend $500 a foot building a data center in the desert in Utah, and it doesn't, you know, and they never sell it, that doesn't matter for them. So they're looking at it through a different lens than real estate investors would, and so that'll be interesting to see. But I do wonder, yeah, if my sense is that data center activity won't have enough of an impact on some of those issues that you talked about, older, obsolete properties, things like that. You know, if you have a 100,000 square foot warehouse that nobody wants to move into, the data center might not really be able to utilize that well, depending on power, depending on everything.
Unless you have power, I was just about to say,
Exactly.
unless you have
Yeah.
power, right?
Yeah.
So if you have an existing, you know, 3,000, 4,000 amps or whatever, that will go a long way. But if you don't, it might be obsolete 100%. Yeah, that is certainly a challenge. Yeah, in those areas, it does seem that you know, the number one driver there, other than, you know, NIMBY's kind of not wanting these data centers built in their, geography for, you know, valid reasons. I mean, it's, you know, driving energy costs quite a bit. But in the markets where they are happening, it's because energy is either cheaper or it's abundant, or the local authorities have, you know, promised to build something to make it so, right?
Right. Right.
Whether it's green or not green, that's a whole other thing, right? But yeah, it does remind me a little bit of life science about 3-4 years ago, when everybody
Mhm.
became sort of a life science developer. I
Yep.
feel like
Yep.
there's a lot of, you know, builders now who are, you know, data center developers, and I'm, you know, curious, when the tide recedes, you know, who's going to be left.
Definitely.
Yeah. So, David, to close our conversation, we have our little feature, Microscope Telescope, which is our way of kind of looking into a topic, you know, more closely, very deeply. If it's a microscope conversation, if it's a telescope conversation, we sort of zoom out, look at things a little bit from a high level point of view. Tell us, what do you have? I'll have you kick us off.
Yeah. You know, some of the headlines that we've been seeing lately have been about vacancy in San Francisco, and San Francisco, near and dear to my heart as a native, and
And this is office vacancy, right?
office vacancy. Yes, office vacancy. Important to make that distinction. So with office vacancy dropping in San Francisco, still above 20%, depending on exactly who you ask, but certainly very, very high by historical standards. And when I, was looking at those headlines and thinking about our conversation today, I wanted to go back and see what vacancy looked like after the dot-com bust. And so I literally pulled up CoStar for as far back as it goes, and the numbers were really, really surprising to me. In the dot-com bust, vacancy increased, but you only got to about 14 and a half,
Like 13, 14%. Yeah. Yeah.
Yep. 13, 14, 15, maybe 15%. And then from 2003 until 2019, vacancy was generally dropping in San Francisco. You had a slight blip with the recession in 08, 09, 2010, but then it actually kind of came down. And even as recently as 2019, according to CoStar, vacancy in San Francisco was only 6.2%. And it's since shot up. It was at about 23% in 2024. And current estimates, 20 to 21%, according to CoStar. And I was so surprised that only 5 or 6 years ago, we had vacancy of 6% in San Francisco office. That kind of blew me away.
And some data points even lower. I've seen number as low as 4.7%, right? So below 5, which is
absolutely,
super interesting.
Depending on who you look at. And
exactly.
there are different reasons for that. And anybody who knows San Francisco office will tell you that Class A vacancy is much, much, much lower than that. And so you do have, this difference there, but you still have 21% vacancy, even after all this big AI boom.
Right.
Office leasing, which has been all over our headlines. And so that was a big surprise to me on a telescopic level.
A couple of things that we're seeing, and you just mentioned it. When you start looking at different tranches, so Class A plus versus A, B, B minus, and so forth. The vacancy kind of goes from very low to very high. Meaning some of those super high level, Class A spaces, it's down into perhaps single digits is what we've heard, but from some brokers. The lower quality of space you go towards, it goes up, right? And so that's interesting. We've certainly heard this kind of flight to quality seems to be happening, and it's a real thing. And so we've seen, even in the, Transamerica building, there's one venture capital firm, Tiger Management, that, leased space for over $300 a foot, which is a huge number compared to an average of, 50, 60, right?
Right.
And so that's interesting. The other anecdote that I've heard is if there's a building that's in distress, so back to our first point, in terms of debt and trying to sort of work out where they are, the tenant broker will not bring a tenant there. They don't want to bring somebody in who's going to deal with foreclosure or workouts or new landlords and things like that. So that is kind of interesting. So I wonder how many buildings sort of that automatically takes out of the market, if you will, right? Where folks won't even consider them because of their financial issues. Again, this is anecdotal. I can't point specifically to a building and say this is happening here, but that's what we're hearing, right? So,
and I'm sure too, with a lot of those types of tenants, they're going to be wanting big TI packages. So
yes.
If an owner is in that much distress anyway, it almost happens automatically just because they're going to want 50, $100 a foot in TI package, maybe more, depending on what kind of lease they're looking at. And so if an owner is in distress, if the property is one of these kind of zombie office properties that's worth 20% of what it was 6 years ago, they've got a loan on it that's well above, the current value, then that owner's not going to be able to invest in it, not going to want to invest
That's
in
right.
it. And then they can't sell it for less than a double-digit cap rate anyway. So,
Right, right, right. And
so there's
the
really
only
no point.
caveat to the TIs, if it's kind of plug and play, ready to go, those buildings seem to be leasing pretty swiftly as well, which is interesting.
I'm curious
No,
about the
that
depth
is,
of that market.
this city, this area, high beta market, right? When it goes low really fast. When it goes high really fast. My prediction, and with this AI, as we're already seeing, is that those buildings are gonna fill up, in my personal point of view, a lot faster than people anticipate. And I would not be surprised if, in 5 years we are back to the single digits again. But that's my optimistic point of view. We'll see.
Yeah,
We'll
I
see. We'll
think
have to come back and revisit.
my view might be a little more pessimistic than yours on that. I'm worried about the depth of that pool, and the reason I was so interested in the topic and going back to the .com bust is partially out of curiosity of whether the AI boom will have a similar bust that we saw in the .com era. So I hope that that's not the case. I love San Francisco and I want it to thrive and be the greatest city ever, which
Yeah.
it really is in so many ways already. Um, but we'll see how deep that tenant pool is
Yeah.
and how sustainable that tenant pool is, right?
Well, what's sort of scary, kind of funny, not funny, is as these AI companies are, basically taking over all the other industries, is their lease demand going to keep increasing, but everyone else is going to keep decreasing?
Right.
Where it's some kind of break even, right? Where we are perpetually on this 20-30% vacancy because of that. So
Absolutely.
we'll see. That's a topic for another podcast. My point is a telescope point, kind of a big picture point of view. This is somewhat anecdotal, but we hear from the people who are leading commercial real estate departments at companies. No one really seems to be kind of talking about going back to work. I feel like there's a little bit of a disconnect in terms of what the industry, in terms of brokers and developers, how they kind of continue to look at and think of these efforts. When are we going to go back to the occupancy we had in 2019 or 2020 or whatever before COVID? And I feel like on the occupancy side, tenants are really thinking more about what role the office plays in their organization, less so than let's bring people back. And again, this is anecdotal from talking to a couple of these folks, more than a couple, but I do feel like there's a bit of a disconnect between the end user, the buyer, if you will, and the supplier of commercial real estate. David, have you heard anything similar? I'm kind of curious.
Yeah, I mean, since COVID started, it was the question. And then more recently, every lease that rolls, I mean, probably a little bit more so on the East Coast markets when we've looked at office deals out there. It's not if they will renegotiate, but how much will they renegotiate? And I'm not talking about lease rate either. I'm talking about square footage, right? So you have tenants that used to occupy 50,000 feet, 20,000 feet, 100,000 feet, who are slashing their office space by 50, 60, 80%.
Yeah.
And so everybody is rethinking it. There's no escaping it. Even people who are, back to work are still working from home 2 or 3 days a week. Even in Facebook and Google, who make those big announcements, people are still working at home.
That's right.
Some portion of the time. And so the space needs have changed. There's just no getting around that. It's the reality of the matter. And so business activity, economic activity, will always have an impact, but office is facing an existential crisis. I mean, I think everybody in the real estate world knows that. Office investors certainly are realizing that, and that flight to quality is leading to big investment in those ready to use spaces, in the high amenities, in strong markets. I've heard from brokers across the country say the same thing that you said about spaces being ready to go, and those spaces lease up quickly. So if you have, 1,500 feet, 5,000 feet, and that space is ready to go, those spaces do lease quicker, and they probably lease at much better rates than something that really requires vision, time, and even if a TI package is strong, people don't want to deal with that. They want to move in ready, just like a house, right? You want to buy a move in ready house, unless you have a very specific vision. But the connection to office is not quite the same as the connection to living space, your home, right?
Agreed.
So, yeah.
Great. Well, David, great to have you today. Very thoughtful conversations. Thank you for your insights. This was great, and look forward to our next discussion here in a few weeks. But thanks again and for joining us, and stay well. We'll talk soon.
My pleasure, Vlad. Thanks so much, and we'll talk soon.